Day, Pankaj Tibrewal, Senior VP and Equity Fund Manager at Kotak Mutual Fund. His fund, Kotak Emerging Equity Fund, has seen a return of 35.5% over the last 3 years. That's annualized, of course, versus benchmark of 26%. Pankaj, thanks a lot for joining us. Now that earnings season is over, and especially you operate in the mid caps and small caps, are you worried about valuations or are you fine with that?
In the near term, obviously the valuations are much above the long-term averages, and hence there could be some reason for correction in this space. But if you slightly look at from a 3 to 5 year perspective, I think the space is really exciting. We believe that over the 3 to 5 year period, there are a lot of companies and business model which probably will be available in this space, which can scale up. And over a period, if you look at, market doesn't understand whether it's large cap, mid cap, small cap, micro cap. Market really asks for 4 questions. One, how predictable is the earning growth of the company? What is the earning potential of the company? Whether the management which is managing the business, can it scale it to the next level? And what is the size today and what could be the size 5 years later? If all the 4 questions are answered on a significant manner over the next 3 to 5 years, that really decides whether a mid cap or a small cap or a large cap keep compounding your wealth and the earnings keep compounding. So our basic thesis doesn't lie whether it's a mid cap, small cap, large cap. We try to find questions to these answers to these questions, and hence select our stocks.
Okay, fair point. Will that be your strategy in the emerging equity fund that you manage? I mean, considering it has done so well in the last 3 years.
There are a couple of strategies. I think there has to be 2 parts to it. One is the stock picking part, and there we are very conscious that earnings growth only doesn't excite us. It has to come with balance sheet and cash flows. We are very conscious about the return on capital which the company can generate over a longer term. And the second part is, along with that, we marry it with proper risk management. And in our view, I think downside protection also is as important as capturing the upside. We all would agree that world is no longer a linear phase. You will have in a year 3 to 4 months where it looks like world is coming to an end. And if there you can protect the capital, I think overall over the cycle your performance looks good. So I think the idea has not only been stock picking, but also capture the downside, protect the downside and protect the capital in the bad times. I think if you can marry those, I think that's what reflecting in the fund's return.
Okay, Pankaj, let's talk about some of your stock picks, because you have high conviction in stocks like Solar Industries, Atul Limited, Fag Bearings, Federal Bank. Any common theme that makes you bullish on these companies?
So broadly, the thought is bottom-up stock picking. Buy good businesses in each sector has been a core theme of the portfolio. And couple of thoughts on sectors. We believe that the capex cycle is probably troughing, and the deterioration which we were seeing for the last 5-7 years probably coming to an end. And hence we are positive on the early cycle plays in the capital goods sector, and which are linked to the core infra growth. So we may not be positive on asset heavy companies, but what is exciting us is the early cycle plays like the bearings, the pumps, the explosives, and so on and so forth. So that's one theme. The second, I think we have been positive for quite some time on the specialty chemical part. I think clearly when we meet companies, one clear theme which is coming out for the last couple of years is that incremental production in China is under problem because of environmental issues, and hence the cost of all these chemical suppliers from China is going up. And if you look at major agro and pharma companies, incremental sourcing is to the Indian players, and that's an overarching theme which we saw in pharma also, say 10 years back. So I think the space clearly is an exciting, and that's where the larger diversified players are clearly a part of our portfolio.
Okay, from chemicals to the other end, hospitals. You hold Apollo Hospitals and you are in good company. Morgan Stanley has picked that stock as its best in the Asian healthcare space. Can you elaborate on this theme itself, healthcare and hospitals?
So healthcare could be divided into 3 parts. One is the pure Indian generic companies which derive a lot of revenues from US. I think there is some problem there because the pricing is under pressure because of consolidation at the front end out there, and the pending FDA issues which are there in most of the companies. We are cautious on that space. The second in that healthcare is the Indian pharma companies which are more exposed to the domestic story, the domestic growth. There we have few names in our portfolio which has done exceptionally well contrary to the entire pharma sector performance. And the third we believe is the diagnostic come hospital space, where we believe that the capex cycle for most of the guys you mentioned are coming to an end. The return on capital starts looking up. This will be the first year for some of the companies which will start generating free cash, which is exciting us. So we believe that the healthcare weightage is for us a part coming from hospitals, diagnostics, and a part coming from Indian pharma exposed companies. So that's where our bets are in the pharma sector.
Okay, to take your view forward on private capex troughing out, which sectors or stocks will benefit?
So in the past we have seen that in the 2002-3 to 2007-8, the early cycle companies multiplied by 15 to 20x in terms of shareholders returns. We are not saying that will repeat itself, but what we are seeing, there are pockets which have started to show some signs of promise. So I just came from a meeting. Meeting a transmission company. Their revenue from railways was 210 crores last year, which is FY16, and FY17 that doubled to 455, and they think that could double again this year, and they are seeing a lot of promise coming from railways. So railways is one sector where most of the companies we are meeting are saying a lot of work is going on, the expenditure is huge. The second I think is power T&D. I think a lot of work now needs to be done post generation now on power T&D. Post power grid, now the expenditure is moving towards the state electricity board. They are in a much better shape than they were in 3, 4, 5 years back, and I think that's another area where we are seeing a lot of traction. The third I think is the road construction and the industrial side. I think there the momentum has started to pick up again, the ordering inflow has started, and most of the road companies and the part of that which is related to road, the genset companies or the companies which cater to the road companies are seeing traction. So I think if you look at these three space, I think it's good. Plus we are extremely, and we have been positive on cement as a sector, mainly coming from the fact according to the capex plus the affordable housing. I think both segments are showing a lot of promise, and cement is the best way to play this sector as well.
Okay, finally, before we let you go, Pankaj, mid-cap cement companies.
So clearly, if you look at cement over the last 10-15 years, there has been a leadership change from some of the larger guys to the so-called mid-cap guys of the previous cycle. I think that trend would continue to happen. What you need to do in cement is that look at few of the pan-India players and look at some of the regional players which may be present in the south, not present in the north, or present in the north, not present in the south. The way we have approached cement is that it's a commodity, and ultimately the players who have the best cost structure and the best overall brand would be the winners in the longer term. And I think if you can get that equation right, in the mid-cap there's a lot of promise in some of the cement names which we have exposed to. Also we believe that the capital allocation is an important component in the cement sector. We have seen one of the companies which used to be a very small cap or a mid-cap is the biggest wealth generator in the space and overall in the Indian equity markets, not because of anything but because of capital allocation. So in a capex heavy industry, if you can get the capital allocation right, I think you can be a winner. So the three things we look at, one is the cost structure, whether they have the right brand in terms of whether they can command a 5-10 rupees per bag higher, and the third most important is capital allocation, that how they can manage the capex cycle well without borrowing or without getting equity raise from outside. I think these three things decide the winners, and I think there are some of the good companies in that space in the mid and small cap.
Okay, Pankaj, I have just one more question for you, but but before that, since we're discussing cement and some of these stocks are active, let me take that question to Deepak as well. Deepak, your thoughts on cement, and we've seen a bit of a correction of late. Are you buying into this correction?
It's a tough question to ask sometimes. On this kind of a rally, the cement companies have done very well. The problem, at one level, there's consolidation. There's ACC Ambuja that's been going on. There's Ultratech, which is consolidating in a way with JP. There is also talk on the negative end of some kind of a decartelization or an upper limit of a rate on cement. I think I'd wait for that to happen. I personally have some interest in Ultratech, so in a way I'm sort of biased towards that company, but I believe the larger players that are consolidating will probably take a big share in this business going forward. If construction is to improve, some of it because of RBI's moves on residential housing, and some of it also because of India's increased spend on construction from a government perspective, I think cement companies will definitely benefit. Some of them are quoting at extremely high PE ratios, so I think they need to perform just to make these. I don't think they're attractive to us from a massive growth story, but I think a diversified player needs to have some cement in that portfolio.
Okay, Deepak, thanks a lot for your time today. And of course, we'll touch base later as well. That's a bit of a news from our sister channel, the land demerger. We all know that it will be announced, but it will be announced next week. So we could be getting closer to that. That stock up 4.5%. But let me get back to Pankaj. Pankaj, final question then. How do you justify holding a company like V-Guard or Whirlpool trading at 40 times forward earnings? Because clearly valuations also do matter.
So if you look at our optimism, obviously the valuations are higher than the long-term averages. But we believe that these companies are in the space where the under-penetration story is very, very strong. One of the consumer durable names which you mentioned, which is present in the refrigerators, washing machine, ACs, I think the penetration, we all agree, is one of the lowest in most of these segments. And with Power for All, which the government is targeting, I think the aspiration level clearly is there in the country. And everybody wants to own a good ref, everybody wants to own a washing machine at some point of time, but probably because of power connectivity or because of disposable income being low, I think they were not being able to do that. I think both are changing in its own way. I think in the next 3 to 5 years, we could see accelerated growth in all the companies you spoke about. We have been early investors in most of the consumer durable names for the last 5-6 years. Though we may have trimmed some position based on the valuation concerns, but structurally, if you ask me, we remain positive on this sector because the runway for growth is quite big and long for most of the companies you mentioned.